Welcome to the deep dive. Today we're taking some pretty dense documents, investor updates, regulatory filings from a major Indian energy exchange and boiling them down for you.
Yeah, we're looking at India's energy transition through the lens of its Q2 FY26 performance. It gives us this really fascinating snapshot of, well, one of the fastest changing energy markets on the planet.
Absolutely. And our mission here is simple. Get past the headline numbers. We want to understand the deep structural shifts happening in power trading.
Like why prices are actually dropping despite growth, what's happening with new areas like carbon and gas trading, and how regulations are trying to keep up with this massive renewables push.
Exactly. And there's one thing that really jumps out from the sources, a kind of signal.
Ah, you mean the trading volume?
Yes. Let's unpack this because it's huge.
Yeah.
For the first time ever, one particular type of electricity trading the real-time market, its volume, completely overtook the traditional day-ahead segment.
That shift, that RTM dominance, it tells you almost everything about how India's grid is actually coping day to day with integrating all this new renewable energy. It's quite something.
But before we dive deep into that, maybe set the scene. What's the bigger picture?
Right, the macro context. Well, India is still clocking in as the fastest growing major economy. Q1 of fiscal 26 saw GDP growth at 7.8%. Pretty strong.
And the Reserve Bank agrees.
Seems so. They revised their full-year GDP forecast for FY26 up slightly to 6.8%. So the overall economic engine is definitely humming along.
Okay, strong economy. But here's the first kind of paradox, right? Electricity demand growth in Q2 was, well, pretty moderate.
Yeah, surprisingly so. About 449 billion units, which sounds like a lot, but it's only up 3.4% compared to last year. And if you look at the whole first half of the fiscal year, demand was basically flat compared to the previous year.
So why the disconnect? Strong GDP, flattish power demand.
The sources point squarely at the weather. The monsoon season was unusually wet, 8% higher rainfall than average, the highest in about 5 years.
So less need for air conditioning maybe. And farming.
Exactly. Less domestic and industrial cooling load. Plus, agriculture didn't need as much power for irrigation pumps because of the rain. It really put a dampener on demand growth, despite the strong economy.
Okay, so demand was softer than expected. But what about the supply side? That seems to be where the action was for prices.
Precisely. Supply was very favorable. We saw ample fuel and, crucially, competitive prices. Imported coal, the 4200G benchmark prices dropped significantly, about 19% year over year, down to around $42 per ton.
19%, wow. And natural gas.
Also lower. Imported gas averaged around $12 per MMBTU. That's down from about $13.60 in the same quarter last year, so more fuel available, and it was cheaper.
Right. You combine that cheaper fuel, that increased supply liquidity with, I guess, good hydro and wind generation, too.
Yep, those are strong as well.
And you get the aha moment. Prices on the exchange just had to come down.
And they did, substantially. The day-ahead market, the DAM, averaged RS 3.93 per unit. That's a drop of 12.5% year over year.
Okay, significant. But the real-time market?
That's the really striking one. The RTM averaged just RS 3.51 per unit. That's down a full 16% compared to the previous year. So not only falling prices, but the market closest to actual delivery is clearing way lower.
Which brings us right back to that core story, the big shift. Q2 FY26, the moment the real-time market volumes overtook the day-ahead market. RTM grabbed a, 36% share?
A massive 36% share of the collective trade, yes. And volume-wise, RTM grew an astonishing 39% year over year, nearly hitting 15 billion units just in that quarter.
So why? Why is RTM suddenly so dominant?
It's become absolutely critical for managing the grid, especially with all the variable renewables. It lets the distribution companies, the discoms, manage their power needs much closer to the actual time of consumption, reduces their risk of penalties for deviating from schedules.
Makes sense. Forecasting wind or sun 24 hours ahead is tricky. Doing it an hour ahead is easier.
Much easier. And generators can also get a better sense of how much power they'll actually have available closer to real time. Plus, there's the price incentive we just talked about.
That 10 to 12% discount compared to DAM prices, that's a huge driver, surely.
It's definitely incentivizing the discoms to buy more in the RTM. Why pay more in DAM if you think you can get it cheaper just hours before you need it?
But doesn't that raise a flag? I mean, if everyone waits to buy cheap power last minute in RTM, doesn't that kind of undermine the economics for the big power plants, the generators who need the certainty of the day-ahead market to plan their operations and finances?
That is the crucial question, and you've hit on why this RTM growth is Well, a bit of a double-edged sword. It's great for immediate grid efficiency and potentially lower consumer costs right now,
What?
but it does highlight the need for maybe better long-term scheduling tools or different kinds of contracts. We'll see that reflected when we talk about the new products they're proposing. For now, though, the market signal is clear. Flexibility pays, and it's driving behavior.
Okay, so this major structural shift towards real time, how did that actually play out on the exchange's own financials for the quarter?
Overall, pretty well on the core business. The electricity trading volume, the total units traded, grew a healthy 16.1% year over year, hitting about 35.2 billion units.
And the bottom line.
Consolidated profit after tax, PAT, was up nearly 14%, coming in at about Rs 123 crore, so solid growth.
But I noticed something interesting in the numbers, a bit of a wrinkle. The revenue growth was slower than the volume growth. Revenue up 9.2%, volume up 16.1%. Why the gap?
Ah, good catch. That difference really tells a story about the product mix. It boils down to the certificates market. Think renewable energy certificates, for example.
Okay, what about them?
Two things happened there. First, the actual volume of certificates traded was lower in Q2 compared to the previous year, about 44 lakh traded versus 63 lakh. And second, there was a regulatory change, or maybe a company decision, to cut the transaction fee on those certificates basically in half.
From what to what?
From Rs 40 down to Rs 20 per certificate. So you had lower volume and lower fees in that segment. While the core electricity trading was booming, the softer certificate market kind of diluted the overall revenue per unit traded.
Right, shows the complexity of running different market segments side by side. Okay, let's pivot now. Looking ahead, the exchange seems pretty bullish, forecasting, what, 15–20% volume growth for the second half?
Yeah, they expect to continue that strong growth trajectory, consistent with their sort of 20% average over the last 5 years.
And that growth seems really tied to some ambitious plans, new market models, and regulatory developments, right?
Absolutely. The future growth really hinges on building out the ecosystem, and central to that is energy storage, specifically battery energy storage systems, or BES.
The key to solving the renewables intermittency problem. Store daytime solar for evening peak demand.
Exactly. BES is the bridge. And we're seeing regulations now actively trying to accelerate its deployment, especially through something called viability gap funding, or VGF tenders.
VGF, viability gap funding. Explain that quickly.
It's basically a government subsidy mechanism. It helps bridge the gap between the actual cost of building a BS project and the revenue it might generate initially, making projects financially viable that might not be otherwise. It kickstarts the market.
And there was some huge news on that front in Q2, wasn't there? A state utility, RUV&L.
Monumental news. RUV&L ran a VGF tender for a massive BES project, 1,000 megawatts, 2,000 megawatt hours. And the price discovered was the lowest ever recorded globally, apparently.
Get this, Rs 1.78 lakhs per megawatt per month. That sounds incredibly low.
It is. It fundamentally changes the potential economics of energy storage in India. If you can secure storage capacity at that kind of price, integrating huge amounts of solar and wind becomes much, much more feasible, much faster.
Okay, BES is one pillar. What else is coming down the pike? I saw mentions of VPPAs.
Right, virtual power purchase agreements. These are financial contracts, essentially, allowing companies to support renewable energy projects without taking physical delivery. The new draft regulations are important because they explicitly recognize power exchanges as platforms where these VPPAs can be settled within the collective market.
So that could bring more volume onto the exchange.
Potentially significant volumes. There's already about 2,000 megawatts of VPPAs operating or being built, and allowing them access to the exchange mechanism could really accelerate that market.
And then there's the big one for industry, carbon trading. Is
Yeah.
that finally getting real?
It certainly looks like it. We now have draft regulations from the regulator outlining how carbon credit certificates can be traded on power exchanges. This covers both entities that have to participate and those that might want to voluntarily.
What makes it real this time?
The crucial step is the notification of specific targets. Greenhouse gas emission intensity GEI targets have been set for 271 specific industrial units. Think big emitters like cement, aluminum plants.
So these companies are now obligated to meet certain emission reduction levels.
Exactly. They have mandatory targets. If they can't reduce their own emissions enough, they must buy carbon credits or certificates to comply. That creates guaranteed demand, which is essential for a functioning market.
Okay, lots of positive momentum on new markets. But we have to talk about the elephant in the room, this market coupling issue. The exchange is actually appealing a regulatory order. That sounds serious.
It is definitely a point of friction. The regulator, CERC, has ordered the implementation of market coupling specifically for the day-ahead market, and they set a deadline of January 2026.
And market coupling means?
In simple terms, it means instead of multiple exchanges discovering their own prices, there would be one single centralized process that clears all bids and offers across all participating exchanges to arrive at one uniform market clearing price.
Sounds efficient, maybe. Why fight it?
Well, proponents argue it optimizes resource dispatch across the whole country. But from the exchange's perspective, the one we're tracking here, it's a potential threat to their business model.
How so?
Their argument essentially is that they've spent 17 years building sophisticated technology, algorithms, and strong customer loyalty. If price discovery becomes centralized and uniform, the main way exchanges compete might just become who offers the lowest transaction fee.
Ah, a race to the bottom on fees, potentially commoditizing their service.
That seems to be the concern. They believe it undermines the value of their technology and relationships. So their strategy, as stated in the sources, is to focus on enhancing their tech further and relying on that customer loyalty rather than getting into a potential price war if coupling happens. They've filed an appeal against the order.
Interesting dynamic. But they aren't just waiting around, are they? They're pushing for new products, too.
Definitely not standing still. They've filed petitions for several new segments aimed at filling market gaps. Things like extending the duration of term-ahead market contracts, letting people lock in prices further out from 3 months now up to maybe 11 months.
More certainty for planning. Makes sense.
Exactly. And critically, they're pushing for a dedicated green RTM, specifically for renewable energy in the real-time window, plus specialized peak DAM and peak RTM segments.
Focused on those tricky evening hours when demand spikes and solar drops off.
Precisely. Tailored products for when the grid is most stressed, which is often when storage will play its biggest role.
So it really feels like the vision is expanding beyond just electricity trading. It's about building a whole energy ecosystem.
That's clearly the direction. You see it in their other ventures, too. Look at the Indian Gas Exchange, IGX.
How's that doing?
Growing fast. Volumes were up significantly in Q2, about 36.6% year over year, hitting over 160 lakh MMB2. And profitability is strong too, PAT up 57% to RS 9.64. Gas is becoming a more significant part of the energy mix.
But there's a small regulatory hurdle there too, mentioned in the filings. Something about ownership.
Yes, a compliance point.
No.
Regulations require the main power exchange to reduce its ownership stake in related exchanges like IGX down to 26%. They currently hold about 47.5%.
And the deadline is coming up.
December 2025. So they're currently applying for an extension to manage that divestment process. It's a structural requirement for diversification they need to navigate.
Okay. And internationally. The carbon side.
Their international arm, ICX, focusing on International Renewable Energy Certificates, or IRECs, is seeing explosive growth.
Oh, explosive.
Get this. In just the first half of this fiscal year, H1 FY26, they issued 82 lakh IRECs. To put that in perspective, they issued 59 lakh in the entire previous fiscal year, FY25.
Wow. So H1 already beat the full prior year. What's driving that?
It's the global push from corporations. Big multinational companies have sustainability commitments, net zero targets, and they need credible, traceable ways to show they're using or supporting renewable energy, even across borders. IRECs provide that mechanism.
So tying it all together, we've got this market undergoing a huge structural shift towards real-time operation driven by renewables.
Yep, RTM dominance is the headline there.
We're seeing aggressive adoption of new tech, like batteries, with these stunningly low BES prices pointing the way.
That BS price discovery is a game changer.
And there's serious preparation for launching these major new commodity segments. Carbon's looking real. Gas is growing fast.
Absolutely. The ecosystem is definitely broadening. The sources clearly show a government and regulatory roadmap pushing for massive capacity additions, something like 80 gigawatts of new thermal power by 2032, but also a huge 47 gigawatts of BSS storage by then.
47 gigawatts of storage. That's enormous.
It is, and the market mechanisms, the price signals, they're getting sharper and louder, which leads to the final thought, maybe something for you, the listener, to consider. We've talked about that record low BES price RS, 1.78 lakhs per megawatt per month. We've seen how the RTM data reveals significantly lower power prices during peak solar generation hours. The question is, how quickly will the big energy users, the commercial and industrial consumers, really internalize these signals? When do they start saying, okay, storage is getting cheap enough, daytime solar is incredibly cheap? Maybe it's time we seriously look at optimizing our own operations, maybe even partially decoupling from the grid during certain hours to capture these savings directly.
So will the users follow the price signals and adapt their own behavior?
Exactly. The technology costs are falling, the market is providing the data, how fast will industry react and leverage it? That feels like the next big chapter in this transition.